Welcome everybody to a special Super Bowl edition of the weekly meetup. 2 p.m. special time. This will be recorded for those who can attend. All right, so agenda today, we got Aaron Warwick presenting on NMRD, then Florian Buschek on PALAF. We'll go through trade of the week. I hear someone's mic audio, if we can mute that. Actually, let me just check our security settings. Okay. Okay. All right. Quick disclaimer. I'm going to spend a little extra time on this. So Story Trading is not an investment advisor. Investing in securities involves significant risk of loss. We're recording this for paid subscribers only. A couple things additional I want to mention, given the market volatility, that any stocks that are presented here by anybody in the community, whether it be Aaron, Florian, myself, anybody, we can change our positions at any time without notice, without obligation to tell you that we're changing those positions, because the market is so volatile and you can see stocks go up, down 30, 40, 50%, whatever it is. It's just crazy time. So just want to put that disclaimer out there. Also, I want to put an informal poll out there. If you could get back to me if you have any special thoughts on this on WhatsApp. We're thinking of soon making our recordings available on social media on a delay. So our paid subscribers will get in ahead of time, be able to see all the content ahead of time, and then we'll release that on a delay. We have to think about how many days, but let's say, 3, 4, 5, maybe 7 days. And there's two benefits to that. One is we want to grow our community, so we want to get the word out there of how successful our community has been. And the other thing is it also helps you guys get the word out about a stock. If you present a stock here, we can help get the word out by publishing that on social media. So just a little informal poll. If you want to private message me throughout this week and let me know your thoughts on a policy like that, or how long that delay should be before we make it available on social media, definitely welcome that feedback. All right, so featured presentations. I'll make a couple comments and I'll maybe turn over to Rob to mention some, but this is absolutely stunning and incredible how we've been doing. 79% with an average holding period of just 4 months. I mean, pretty much every single sell. Look at this. Dan Carlson hit it out of the park with Adam. Rob's Real Networks, 185. I mean, absolutely incredible. It is unprecedented times. I don't think we can expect returns like this always, but Rob, did you have a couple additional comments on this?
Yeah, pretty much everything in the whole chart is green across the board. Within 80% is not very unusual for like 3 or 4 stocks if you pick the right ones, but to have maybe 15 or so stocks with a total return of 80% in 4 months is amazing. It's a great job by all presenters, and maybe doing your due diligence. The only thing I could say is now that the market's getting kind of crazy and wild, we still want to stick to the strong stocks with kind of great products, great features, great fundamentals. And even though you think a stock could run because it has crazy sentiment, just sentiment, I don't know that we want to take a look at that one.
Yeah, you brought up a good point. I want to remind everyone, Dan Carlson, we have to reach out to him. He didn't close his position. He still says he has a large position, but he did say he trimmed it in the Adam room. He said he trimmed his position because the stock has gotten a little ahead of himself. So Rob, you make a good point. Anyone who's presented any of these stocks, maybe Florian, you might want to look at David's T, but let us know if you think it's time to close it out of this presentation list. Everything that's listed here is basically stocks that you think still is a buy. That's the idea here. We have INTZ, which we closed up 175%. We should probably create a separate table side by side to show the ones that have closed out. But please let us know if you change your opinion on a stock.
Yeah, because we also want to get a view of all the stocks that still have room to grow and room to run up. So if you've closed out most of your position, let us know, like Ben said, and we could close out the position here and make more room to watch other stocks and give everyone else like ideas of what they should be buying and what hasn't run yet.
Yeah, and maybe a simplistic view, the top of the table, everything's up about 100%. Down here, maybe they're coming next. I don't know. Maybe that's where you want to be overweight in, are these PBI, MLSS, Kintera, APT, these stocks. Starting point to look at
some of those
possibly.
ones are the ones that haven't run yet. I agree.
Yeah. All right. So sorry, go ahead. What was your last comment there?
There are some at the top, like, what was it, BCRX, SMSI, and Real Networks still have room to grow, even though they made it to the top of the chart, and like TFFP as well, DRIO. So we should probably just clean up the chart and see what's left over, but some of the highest runners still have a lot of room to grow.
All right. So go ahead and try to share now if you can.
No. Because you are sharing. It says you are sharing.
Oh, okay. Okay, go ahead.
Okay, can you see this?
Yep.
Okay, so I'm talking about uranium in general. Uranium is the stuff that goes into nuclear fuel plants, nuclear fission. So what is important to understand, I will make this quickly, I will make this these slides available afterwards, just a lot of background information. So the nuclear fuel cycle, what happens with uranium is you have in the ground, in the rocks, you have uranium oxide. You pull it out of the ground, and then what you need, it has very low grade, and especially what you want are certain isotopes, and these are very strongly diluted. So it gets converted into a gas, hexafluoride, and then it is enriched. This is the same process as would happen for a nuclear bomb, basically. Just for nuclear weapons, you enrich them more. So for nuclear fuel, you enrich them to about 5%. And this happens in with basically the gas. It is converted back again, and then your finished fuel is put into these kind of zirconium fuel rods. What is important to understand about this whole process, it's very complicated, it's messy, and it takes 2 years minimum. If you're very lucky, you get it just below 2 years, but usually it takes from digging it out of the ground to having it in your nuclear reactor, it takes 2 years. So if you're a utility and you find yourself short of uranium in a year, you have a problem. So what about the uranium market? We are and have been in deficit for quite a long time. So these are some numbers for 2019 and 2020. COVID didn't help because some mines had to stop production. And in general, the outlook is quite striking. So these are from a sector body, the World Nuclear Association. These are their base case numbers. And you see, if you go beyond 2026 to 2040, the supply shortfall is quite amazing. And it's important to go as far out because building mines in general is very difficult for every mine, and it takes quite a long time, and for uranium especially. It's not uncommon that it takes about 10 years to have your mine. Once you know that you have actually a resource, an economic resource, to actually have a mine, it takes quite a long time. So this is a supply-demand picture, which looks very favorable. A little bit about nuclear electricity generation in general. It's very clean. There are almost no CO2 emissions associated with it. And it is also very safe. So you would think, yeah, there's Fukushima and there was Chernobyl, but actually it is the safest method to generate electricity of all. It's hard to believe, but there's stuff happening, like when you install solar on rooftops, for example, people fall off the rooftops and die or whatever. And so if you add it all up and you do it properly, you will find that nuclear energy is the safest form. it is not growing quickly, but it is growing, especially in emerging markets. And so there are still reactors underway and being planned and being built. So this is how the utilities are contracted. So right now they are still very well supplied with about 100%, but if you look further out over the years, it falls off quite quickly. And if you look on the right side, contracting activity has declined quite a bit in recent years. So this was around the last peak, and from then it has gone steadily down. So back in these days, utilities have basically over-contracted, and all this inventory, let's say, is getting worked off right now. So looking at the price, this is the blue line is the spot price and long-term price is in red. It spiked quite hard around 2007, beyond $150. And right now we are around 30. Now, what happened back then is a bit complicated. So it's not an easy story to tell, but there was quite a bit of fear amongst the utilities that they were running out of uranium short-term. And then a lot of hedge funds and other investors piled in and bid up the spot price. And so you got this boom and bust. But overall, if you had looked at the supply demand picture back then, there was no deficit. There was a short-term supply shortfall, but there was no overall deficit. Today, we are in a severe deficit. As I've shown before in the outlook from the World Nuclear Association, unless different from the last peak, now we are in a severe deficit. So you would think that prices will go even higher. It's certainly a possibility. This is uncovered requirements from utilities, goes back to the same thing I talked about a little bit before. In the last peak, the shortfall was less than today. So today we are in a much more severe situation actually for utilities. On top of that, you have few of the old mines closing very soon because they are just mined out. A few of the 10 most important mines will close very soon. And this is one scenario to model it out. There are different ways to do this, but you can see the deficit is quite staggering if you look out over the next decades. And if you compare the cost curve to how much that is actually needed, we are very quickly in an area where we go to $60 a pound. Right now it's $30 a pound. So the story has been uranium was left for dead for very long, and it was years of false starts and of people having nothing to show for their investments. But now it's rapidly turning. So you see this this is one of the sector ETFs. The inflows in December were quite amazing. And pull up any ticker, any uranium ticker, it probably has doubled in December. I did not participate in that. I was not early enough. Why did this happen? I think there's a whole host of reasons, but one was there was a big write-up for institutional investors, I think, and this got also shared on Zero Hedge, and then the whole sector basically went a little bit nuts. So, but still, it should be said that despite the performance in December, all these names are still severely undervalued and very cheap. So what are ways to invest? The most basic and easy way is to buy physical funds. So the two physical funds are Yellowcake and Uranium Participation Corp. I would prefer Uranium Participation Corp for a variety of reasons. One of them is that it trades in the US. And this is really the easiest way to play this. As I said, uranium is currently trading about $30 a pound. And it basically has to go to $60 a pound. And the risk that it goes below 30 again is basically zero. There's just no chance that this will happen. The question is, how long do you wait for your double? But it's probably the most sure double I know. Then you can buy sector ETFs. So these are two of the better ones. There are other ones that are quite horrible, to be honest, but these are quite good bets. And as you go down this list, the risk obviously goes up as you go into single names. The biggest producers are Cameco and Kazatomprom. These are certainly also good bets. They won't go away. They are solid companies, both of them. And then you come to the smaller producers and the ones that do not produce, but are near-term producers. For example, Paladin Energy. So this is one in Australia. It has its mine in Africa, but it trades on the ASX. It has a US ticker also, which is PALAF. And its mine is currently in care and maintenance, but is one of the first ones that basically will produce. So then you get to developers. These are the ones that have an economic deposit, but which has never been mined and is currently just being fully developed. So these will probably take 1 to 2 years or so until they potentially get into production. But of course, for this risk, you're also compensated by more opportunity. Explorers are the ones where you literally bet on the fact that they do find anything. So you can, if some of them do, you can get easily 10 baggers overnight with these guys. No exaggeration, but it's very risky, and I wouldn't necessarily recommend it. And then there are also typical for any uranium cycle is that the longer the cycle goes, the more fraudsters show up and basically to steal your money. So I have included here a list of lots of names from the sector, just to have a little bit of an overview. And there are also some notes of what has changed in 2021 or what will change. This is for you to read them at your leisure. And I will just quickly note about Paladin. So Paladin it went bankrupt in the last cycle, basically. The mine itself has only produced for a very short time, and it has been very long in care and maintenance. It was all out of bankruptcy. It was basically got new owners, and right now it's one of the better ways to participate in this upcoming cycle. So they still don't produce anything, but they will restart as soon as they get enough contracts. The costs are quite low. If you look back at this curve, so we are about here for Paladin, and the restart costs are also relatively low. So there are other ones that are able to restart rather quickly, but most of them have at least as much in cost to restart, and some of them also higher production costs. There are more things to say about Paladin, including that they have some debt, but this is not due until 2023. So I will do this just quickly to tell you what's the story behind it. And my assumption would be that they will get contracts either this year or next. Until then, I can't say what happens with the share price or with the company in between. But once they do get contracts and once they do start production, I think the stock will do very, very well. It's hard to predict any stock price movements or even a price target. If you were to do just a normal DCF based on today's spot price or even 30-40 pounds uranium, the stock will probably be fairly valued. But since I do expect that uranium will go to at least 60, There's lots of potential for Paladin. So again, just highlighting this again, the easiest way to do this is really via sector ETFs or physical funds. And then you have to do a lot more work if you want to go into the other names, the more risky names. And yeah, with that, I'm basically finished.
Great, thank you, Florian, for that presentation. Let me start off with a quick question. You mentioned the Paladin may be fairly valued now at today's uranium prices based on a DCF. Say it goes to 60 or doubles, forget about 60, let's say it doubles. What kind of leverage is in their business model in here? Like, does that mean a double for the share price, or does that mean much more than that?
I would say much more.
Any way you can quantify that somehow?
Yeah, so you can look at, so it's difficult to say. What will happen is they will announce, the mine hasn't started right now, because to restart the mine, they need debt financing, additional debt financing, and they need to come up with the CapEx. And so they will only basically do these contracts when they get at least 40 pounds. But then they have locked it in at 40 pounds, at $40 a pound. So it's tough to say what price in the end they will get, but there is a very big leverage to uranium prices in general. If you model this out and you do a little bit of make a little bit of assumptions, then it's really, let me share you something. Can you see this?
Yep.
So that's the leverage they have to uranium prices. That's cash flow per year. It's not even, it could easily happen that uranium goes to 80 because the supply shortfall is so severe. So if you look what happens to cash flow in that case, and additionally, the fact that they have debt gives you additional leverage. So, and it's rather, Paladin is an investment that is rather safe, I would say. Yes, they do have debt, but they have quite friendly lenders, and they also have they only have to refinance in 2023. There's enough time to do that, even if uranium didn't take off.
Okay, cool, thank you. Rob, any questions?
Yeah, we have a couple of questions. So one from Ashley. I'll unmute you now.
I am interested.
Hey, Florian, great presentation. I was curious as to how the contracts look. Sort of, if they sign a contract this year and say the price is around 40, do they sign a sort of a contract for like 10 years at $40, or do they have escalations in there, or?
Yeah, so these contracts are typically very complicated. So some of them are referenced to, in general, speaking in general, some of them are referenced to the spot price and just put on an additional margin. Some of them are for fixed prices, some of them are for 5 years, some of them for 2 years. I don't think 10 years, but what is important to know about Paladin is management is quite clear that they will only restart if they have enough contracts in place that their lenders will give them money to restart the mine. So they won't do stupid stuff. They will make sure that they have enough of contracts in place, and they will not start contracting below $40. Most likely around 50, I would say, and probably then some more at 60. Additionally, for Paladin, they have 25% exposure to spot prices. So let's say they contract everything that they can contract at $60 a pound, and then the spot price goes to 150. they still have some leverage to that as well, because there's 25% that goes to CGN mining, which is a Chinese utility. It's not CGN mining directly, but it's a Chinese utility basically. It's part owner of Paladin, and they have something like an offtake agreement of 25%, and they get spot price for that. So even if they are fully contracted, there will still be some leverage left. And not only that, there's also a big portfolio of exploration assets. So it's not only Lange Heinrich, the mine that they have, but it's also some other upside there.
Great, that's very helpful. Thank you.
And
So
we have
then I saw
another
a question about when contracts are going to start. The truth is I have no idea. People said contracts have to start for about 2 years now, but it's getting very, very close. I mean, as I said, the fuel cycle takes 2 years, and some of these utilities are really running quite close to getting there, quite close. It has been delayed due to a whole host of political reasons, not only COVID, but also there was the Trump administration had something planned to protect domestic miners, but that didn't really work out. And then there was a possibility that US utilities could only buy or had to buy a certain percentage of US uranium. That didn't go anywhere basically, but it was all sort of an impediment for utilities to start contracting. And so it got delayed and delayed. And to be honest, the longer it is delayed, the higher the price will spike in the end.
Sounds good. We have another question from Tom
So
W.
biggest risk for Paladin in terms of that. Yeah, so if there are no contracts coming until 2023, the whole thesis about uranium is wrong, to be honest. I don't see any possibility that there won't be any contracts in 2022. Maybe there are none in 2021 this year, although I find it unlikely. But in 2022, there's just no way. It just doesn't work out. The lights will go out, literally.
Hi, Florian. It's Thomas here. Just a couple quick questions for you. The first question, so this sounds like it could potentially be sort of a longer term play, right? Into 2022, potentially.
Yeah.
We might not see anything this year, correct?
It's possible, yeah.
Okay. And then my second question, why Paladin over the other competitors? It seems like there's a bit more risk with this company versus the other producers. Can you just
yeah, so why Paladin and why not, for example, the producers Cameco and Kazatomprom? I am very confident those will do very well as well. The issue is valuation. Those are much bigger companies, and they have also various forms of state involvement in terms of Kazatomprom, and Cameco has also a good amount of debt. And I should mention about Cameco, they have 2 mines, basically. They have some smaller ones as well, but 2 main mines. The one is McArthur River, the other one is Clean Lake. It's a Clean Lake. One of them is indefinite care and maintenance. The other one is in short-term care and maintenance. And they are in a quite tough spot at the moment because talking about McArthur River, they have an all-in sustaining cost about 30 to 40, but to make money, they need a price of 40, let's say. So what they have done in the last couple of months and years is they bought themselves in the spot market and supplied it into their long-term contracts. This doesn't work anymore right now because either way, they are not really profitable. So they are in quite a tough spot at the moment. And not only that, their mine is getting old as well. And they are currently getting into a certain zone of the mine, of the main mine, which is not official, but unofficially very difficult to mine. So it could happen that there will be some nasty surprises. And that's why I'm not that interested in Cameco. And then Paladin is much smaller. So in terms of valuation, I prefer Paladin. But in general, it's very difficult to sort of compare different names. There are other near-term producers and developers that offer very good risk reward as well, but that sort of goes beyond this presentation. And that's really up to everybody individually to decide how much risk they want to take and how much work they want to do. Because there's quite a bit of work involved to go through these economic studies and to see if management actually makes sense in what they claim to have. As I said, there are lots of rather dubious management teams, and it's not always advisable to believe everything management tells you, especially in mining and most especially in uranium mining.
Sounds good. Thanks for the presentation, Florian.
Thank you, Florian. And we opened up the uranium Paladin PALAF research group. Put a link in there in VIP Investing Now, so we can continue the conversation there. Okay, cool. Thank you. Thank you again, Florian. Before we go to the Trade of the Week, going upcoming schedule next week, the event will be on Monday night, not Sunday night, because Monday the market's closed, February 15th, 9 p.m. Eastern. The agenda is to be announced for then. Then Wednesday, February 17th, we have Larry Jasinski, CEO of Rewalk at 4:30 p.m. That should be interesting because this is a stock that is doing well recently and a lot of the traders are on top of it. So we're going to find out if the fundamentals warrant this move. And again, happy hour resumes 4:30 p.m. every Wednesday. So we're going to end the recording right now and we'll move on to our Trade of the Week.